Welcome back to the Lance Roberts Show podcast. We're talking with Kevin Duffy. He's the co-founder of Bearing Asset Management. Go by his website, bearingasset.com, or follow him on Twitter. He's a great follow. Lots of great tweets every day coming from Kevin. It's at Kevin Duffy 1929, which is kind of ironic considering he's a short seller. 1929. Get it? Joke. I love it. All right, Kevin. I wanted to come back. We were talking about China and trade and the impact on potentially, this being one of the potential events that leads to an issue in the markets. We talk about the markets from a valuation perspective. One of the things that we see in the market, this bull market's a decade long. We've seen this inflation of asset prices, not only in stocks, but also in bonds, corporate debt. In fact, we have more BBB rated corporate debt on the verge of a downgrade into BB than ever before in history. 50% of the BBB inventory is subject to a potential downgrade. So, there's a real risk here, and all it takes is some type of event that triggers another credit-related issue in this market, kind of brings the whole house of cards down. But this seems to really kind of bypass investors. They're exuberant about the markets, and that it's just 10 years into a bull market. It's just going to continue indefinitely. What's the risk?
The problem is that that bubbles really start with the lowering of interest rates, and it creates malinvestment. And the problem is that what's happening is that the capital is being squandered. It's being consumed. So the lower interest rate, the fake interest rate, is sending a false signal. It's, first of all, it's lowering the hurdle rate for investment. So that's where you get these unicorns that are losing money. Well, what are they doing? They're consuming capital. On the other side, to savers, it's telling them don't save. So you're not getting enough savings to finish these projects. And so this is the problem that you have with bubbles, is that you get this malinvestment, and eventually you run out of bricks to build the building. Mm-hmm. And then what happens is capital gets scarce again, and everybody is bidding up the existing capital, i.e. interest rates start to go up. So you're starting to see this already. You're starting to see some cracks. It's very uneven. It's so, for example, you're seeing in the auto finance area, you're starting to see interest rates go up. You're starting to see rates go up for small businesses. You're seeing them go up for some of these money-losing companies like Tesla. Mm-hmm. On the other side, you have this huge dichotomy where you've got $11 trillion in negative interest rates. So governments like Germany's able to borrow at negative 20 basis points. Switzerland's able to borrow at, I think, negative 40 basis points. The thing about Germany, and this is part of the problem right now, is that there has been this huge dichotomy between sort of the haves and the have-nots recently. I'd say in the last 6 to 12 months. So Tesla, for example, let's say 2 years ago, Tesla was able to borrow at 5.5%. Now they're at about 9.5%. Whereas some of these big multinationals like McDonald's are able to borrow in euro at next to nothing. Mm-hmm. And so you're starting to see this demand for capital, and you're seeing these the most extreme, the most egregious projects not getting the capital. They're getting starved for capital. That, I think, is what is the trigger in starting to bring this down.
So Kevin, you bring up an interesting point about unicorns. If we go back in history, right, 2000, what was that? That was the dot-com crash, right? You talk about 2008, that was the subprime crisis. Currently, we have 336 unicorns that are being tracked in the market today. That certainly doesn't sound like a rare entity in the current environment.
Yeah, and one of the differences this time with the tech bubble has been the seasoning of companies that have gone public, and the fact that we had this wild IPO party in 2000 where you had the Globe.com. I don't know. I think the first day it was up like 3 or 4 times. you had some just craziness going on in IPO land. And it was very, anybody who is a contrarian, a student of bubbles, kind of recognized that and said, we've never seen anything quite on this scale. Well, this time, and I think back then the average tech company going public was 4 years old. This time it's something like 10 or 12 years old. Mm-hmm. And so the argument is, well, these companies are more seasoned. You're not seeing the first day IPO pops, other than something like a Beyond Meat that I think went up 100% or 150%. But so, the argument is it's different this time. The problem is that we had a much more robust market for private equity and private investment in startups for a number of reasons. And so what's happened, though, is that this time the companies that are going public, yes, they're more seasoned, but they've been able to hemorrhage red ink for much longer and on a much grander scale. So if you look at Jay Ritter, at the professor at University of Florida, studies the IPO market. And back in 2000, 80% of the companies going public lost money. This time, we're up to those levels, about 80%.
Right. It's interesting. You mentioned Beyond Meat. I find that an interesting story. I want to talk about Tesla too, very quickly. But I thought Beyond Meat was very interesting because, this is a very specific target market that they're going after. And the question is that target market large enough to actually support the valuations that people are putting on, this particular company? And, also with this idea that there's other companies, that will come to market that will produce a similar product if Beyond Meat is successful. But there already are other companies working, like with Burger King, with the Impossible Foods. So, is this something that investors are tending to overlook, is, really what the potential return is when they're talking about, trading and valuations that they're putting on some of these companies?
Yeah, and I think, this is really the intersection of so many bubbles. I think there's an ESG bubble, the socially responsible investing, political correctness, whatever you want to call it. Millennials now they have a different way of looking at the world than perhaps my generation. And I think we're pretty close in age. So our generation had, so I think what happens is the millennials are, they're kind of rejecting some of the older consumer brands of their parents. They're into technology, so they fall for something like Bitcoin. I don't have a strong opinion on Bitcoin right now, but I did think it was a bubble back in late 2017, early 2018. And, this Beyond Meat, you make a good point because the market, this is a company, it's trading at $6 billion market value. They had $88 million in revenue last year. They lost money. The Beyond Burger has gotten mixed reviews from what I can tell. How healthy it is, who knows? It's a narrow market. Tyson Foods had a 6.5% stake. They sold it. They're not on very good terms with Beyond Meat, and they're developing their own competing product. Yeah. And so, you also, as an investor, we like to focus on three things: cycles, trends, and moats. And you look at something like Beyond Meat, how much of a moat do they have? But getting back to the socially responsible part, I think that some of the younger investors are falling for a Beyond Meat because that's the way they're wired. Yeah. And I think it's great for us because it's going to create opportunities both on the long side and the short side.
Absolutely agree. Stick around. More with Kevin Duffy coming up right after this break on the Lance Roberts Show podcast, right here, realinvestmentadvice.com.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.